Hey guys, welcome back to the Passive Money Podcast. If you haven't seen us before, my name is Alex. Kirby will be joining us shortly on this podcast. We will be talking about opportunities that you can take advantage of in a bear market or recession.
Alex, before you get started, just a service announcement to everybody who's watching. Please hit the like and subscribe button. It helps the YouTube algorithm so we can get our information out to more people. So our listings and our postings can be higher up on the chart so people can get information to help them out better financially. All right, Alex, what you got?
All right, so on this discussion, I think what would relate to me most in what, the situation I'm in that I can take advantage of is for now the stock market. I'm not so much on the real estate level yet like you are. But in stocks, I'm seeing a lot of the stocks that I'm investing in coming down to levels that are very nice prices. And, a reminder to people getting invested in the stock market, don't look at your portfolio as some sort of bank account where you're putting money into it and you're supposed to be growing interest. It's not how it works. You're buying shares of companies, and those shares of companies are valued by the investors. And in a bear market like this, you can often get, good value stocks at a cheaper price and take advantage of the situation and market that we're actually in getting those same stocks at a cheaper price and building up a position that can later on grow into, something worth more, more valuable, and then see those equity results. But, and there's also other advantages to stocks where you can, like with dividend stocks, some of the stocks I'm invested in are dividend paying companies. So the lower that the stock price is going actually yields a larger dividend, less cash up front for the same dividend. And those are some of the advantages that I'm seeing as well, and taking advantage of it as much as I can currently. What about you in the stock market world?
Everything that you said is true. All most wealth, not all, most wealth is built and fortunes are created in a bear market. Because
Mm.
every time you hear about people, oh, they bought this stock at this low price and then it went up. They had to buy it at a low price. So the stock itself, no matter if it's an index or an individual stock, it had to be in a bear market or down substantially from where the price will be at in the future. The key with building wealth and stuff like that, it's mostly done in a bear market. You have to have the fortitude, like Warren Buffett say, you have to buy when others are fearful. When everybody's fearful, that's when you need to step in and buy shares. Even it don't matter which way you go with the shares. You don't have to go on the extreme aggressive wild side of buying all the super penny. Don't buy any of the penny stocks, but the low super high growth stocks and things like that. You can do it in an inverse. In the stock market, it's always a bear market, just like you might hear Jim Cramer on TV say, there's always a bull market somewhere. There's always a bear market somewhere also. So the key is to buy stocks during their bear market, during their bear market. Not it don't matter if the whole stock market is bear or during their bear market. Like we talked about when we was in a hyper growth cycle after COVID, and I was saying, hey, buy the dividend kings and aristocrats because they was down super cheap, paying a super big dividend. And then when we hit this apex in 2022, the dividends like the Altrias, the Procter and Gambles, and things like that, they continue to go up when the rest of the market was going down.
Right.
And then now it's the inverse. You don't have to sell the dividend kings and aristocrats now because they're up. If you want to, you can. That's totally fine. But you know that when you looking at your accumulation cycle, when the market turns around and go back to the growth cycle, and then the defensive or consumer staple stocks start to go down, that's when you start buying them again if you hold it for the drip or the dividend or the long-term payment and stuff like that. So right now we have the defensive stocks up. You have some oil stocks up. That's not where you should be buying. Where you should be buying is where the low hanging fruit at. You got the apples that's down there. You got the Meta that's down there below, their 5 year trend line. You got a lot of them. I mean, if you want to go to the Chinese stocks and look at the EV space, you got NEO that's down there in depressed levels. You got Tesla that's down there at low levels. You have Amazon that's down there at a very cheap valuation. You got the lending clubs and the Fords that's down there also that you can pick up in this low bear market type swoon to buy them now, accumulate shares at a cheap price. And I'm not, endorsing none of the stocks, but I'm just mentioning how stocks are down well off their highs, 20, 30, 40% well off their highs. if you want to play those spaces, you can buy those shares super cheap now and wait for the next growth cycle to come.
Right. And I mean, especially like you were saying, when you are buying, like in a bear market right now, you start to see a lot of the dividend stocks get a lot of attention and get bought up. And that's really the nice thing about, balancing your portfolio to where you have, like we talked about in our class, buying growth stocks to produce high income on the option side, but also using some of the profits to purchase some of these dividend stocks, dividend kings and aristocrats, so that we're continuing to maintain that income. But while the market may be down for growth stocks, the market goes up for dividend stocks and vice versa. And you can kind of capture both markets that way.
Right.
And
Sorry to cut you. Sorry to cut you off. Go
go
ahead.
ahead. Go ahead. Go ahead.
No, okay. So, but the thing is, if and like you said, having it balanced, having some defensive stocks and then having the hyper growth. So we know how the cycle works. It's going to go like this. It's going to go like this. So when the super growth stocks are up, then the dividend stocks or the dividend kings and aristocrats are down. And then when the economy starts to struggle, people will run into the defensive stocks, so they will go up, and the hyper growth stocks will go down. But what that's giving you is an opportunity to, if you need capital for a certain amount, I mean, at any point in time, in a bear market or a bull market, you will have an avenue or a place to go to grab capital if you need to go put it out. So, of course, you sell high. So, in this environment now, they're talking about recessions and everything else. The dividend stocks are high. So, if you needed capital, you would take away from the defensive stocks. And then if we get another, 2020, 2021 situation and your defensive stocks are down and your growth stocks are up and you need capital, you always have a way to go, somewhere to go to grab capital in any environment if you have it balanced, some defensive, some growth. And
Right.
however you want to play, what side you on, that's on you. I don't have a particular percentage of, oh, you need this much defensive, this much growth. But if you split it 50-50, then that gives you, a better a better balance holding, so you can always have somewhere to draw capital from
Right. And
if you need the capital.
right. And especially reiterating on what you said, don't buy penny stocks. When you're investing in the stock market, you want to look at actually you are investing, buying valuable companies, not just gambling your money away. And penny stocks, if a penny stock is down, it's probably always going to be down. So if you see good company
Right.
stocks that are down, then there may be an opportunity there for you.